My dear friends, welcome to Raj Sekar classes. This is lecture number 25. In this lecture, we will try to understand debt to asset ratio. What is this debt to asset ratio? Just try to recall what we discussed in our previous class. We were discussing about the solvency ratios in which we completed debt to equity ratio. In this particular class, our session, we will try to understand what is this debt to assets ratio. Now let us try to understand formula first. What is this debt to asset ratio formula? Total debt by total asset. What is total debt? Total debt means this includes all liabilities, isn't it? Total assets means it includes assets owned by company, both tangible assets, intangible assets. Now let's try to understand its purpose. To assess a company's financial risk, it's useful. Its higher ratio suggests greater reliance on debt for asset financing. A higher ratio indicates that large portion of the company's assets is financed through debt, suggesting higher financial leverage and potentially higher financial risk. A lower ratio indicates that smaller portion of the company's assets is financed through debt, suggesting lower leverage and potentially lower risk. Anyway, how to calculate we will see. Just it's a simple what you have to do: identify total debt, determine total assets, apply the formula. Just take one simple example. Let me assume this is my debt. Let me assume this is assets, and just I'm substituting total debt by I'm dividing with assets. I'm getting 0.5 or 50%, isn't it? Let me take another example. I'm taking company A and company B. I'm applying the same formula for company A and company B. Company A has got what is the company A's debt to asset ratio 0.3 or 30%. For company B, it's 0.7 or 70%. What is analysis? This analysis is important. Company A has a healthier financial position. Company B is more leveraged and and has high financial risk. Low ratio, low risk, high equity, high ratio, high risk potential for financial distress. Isn't it? What are the advantages? The bigger, the quick. It's I can say what is the advantage of our debt to assets ratio is quick measure of financial risk, useful for benchmarking, helps in assessing long-term sustainability. What are the limitations? Does not account for cash flow. Higher ratios may not always indicate financial trouble. Industry-specific benchmarks vary. I can say then what are the conclusions? The debt asset ratio is vital for financial analysis. Understanding its implications helps in better decision making. Always consider industry norms and context. The ideal debt to assets ratio depends on the industry, company size, and specific financial strategies. However, there are some general benchmarks and interpretations. Low risk industries, example technology and services, ideal range is 0.2 to 0.4, that is 20% to 40%. These industries tend to rely less on debt due to volatile revenues or high investment in intangible assets. High risk or cyclic industries, manufacturing, energy, ideal range is 0.4 to 0.6. Companies in these sectors may use more debt because they have stable, tangible assets that can serve as a collateral. High capital intensive industries, example utilities, infrastructure, idle range is 0.6 to 0.8. These companies often operate with higher debt ratios because of predictable cash flows and asset heavy operations. I can what are the key considerations? 0.0 to 0.2, very low reliance on debt, indicating a conservative financial structure. This could mean missed growth opportunities if the company is not leveraging debt efficiency. If I say your debt to equity ratio is debt to assets ratio is 0.5 to 0.6, means moderate reliance on debt, generally considered healthy for many industries. Above 0.7, if you have your debt to assets ratio is above 0.7, high reliance on debt, signaling a higher financial risk. This could lead to difficult during economic downtrends or periods of declining revenues. Thank you very much.